Hello traders, I'm Haley with FXWMarkets, and this is your U.S. market outlook for February 26, 2026. Today we're covering the S&P 500, the Nasdaq 100, and gold with a focus on what matters most over the next 5 to 15 trading days. The overall trend in U.S. equities remains upward, but confidence is only moderate. The rally is being powered mainly by mega-cap technology stocks, while geopolitical tensions continue to create sudden pullbacks. Let's begin with the S&P 500. The index is currently trading around 6,946. The key resistance zone sits between 6,998 and 7,000. A clean break above 700 would be a major psychological win for investors. On the downside, the critical support level is 6,885. If the S&P fails to hold that level, the uptrend weakens and a deeper pullback becomes likely. Next, the Nasdaq 100. It remains the strongest major index, currently trading near 616.42. As long as the Nasdaq holds above 610, momentum in the technology sector stays intact. Nvidia continues to set the tone for the entire market. If Nvidia loses momentum, both the Nasdaq and the S&P could feel the pressure immediately. Now, gold. Prices are hovering between $5,170 and $5,198. Gold remains in a strong bull market. The fact that gold is holding near these elevated levels while stocks are near record highs tells us something important. Institutional investors are not fully relaxed. They are participating in the equity rally, but they are also keeping protection in place. And here's the key: geopolitical risk is the main reason gold refuses to fall. US-Iran negotiations remain fragile. Any breakdown in talks, any escalation in the Middle East, or any unexpected military headline could trigger a fast spike in gold. That is why large institutional investors continue adding to their gold and silver positions as insurance. Three forces are shaping the next 10 trading days. First, the Nvidia Effect. Mega-cap tech is doing most of the heavy lifting. Second, geopolitical uncertainty. US-Iran talks are the wild card. Third, interest rate expectations. If jobless claims stay low, the Federal Reserve may delay rate cuts, which affects valuations across the board. Looking ahead, the most likely scenario is a controlled grind higher in equities, with occasional 1% dips when negative headlines hit. A bullish scenario would see the S&P breaking above 7,000 and the Nasdaq pushing another 3 to 4% higher. A bearish scenario would be triggered by a geopolitical shock or a hot inflation report, leading to a 3 to 5% fast drop in stocks and a surge in gold toward new highs. For long-term investors, the primary trend is still up. For shorter-term traders, the 6,885 level on the S&P is critical. For risk-averse investors, gold continues to prove its value as a portfolio protector. I'm Haley with FXWMarkets. Stay disciplined, stay informed, and trade with a plan. Trading financial markets involves significant risk. Never trade money you cannot afford to lose. For more institutional-grade insights, follow FXWMarkets on YouTube, Facebook, Instagram, and Telegram, and visit fxwmarkets.com. Trade smart, trade confident, trade with FXW Markets.